We're now joined by Kaylie Tiessen, economist with this country's largest private sector union, Unifor, and Ted Mallet, who is the Conference Board of Canada's Director of Economic Forecasting. Hello to both of you.
Hi there.
Hello.
So, Kaylie, I'm going to ask you to start us out here because we have heard Tiff Macklem say that possibly an interest rate cut would happen this month. Do you think it's actually going to happen?
I have two thoughts on that. The first is that I think the bank has been overly cautious all year and even longer. So, I'd put the probability of a rate cut actually around 50-50. But in my view, it's long past time actually to lower the rates. We've been in that 1 to 3% band already for the entire year. People are really feeling the pain of the interest rate being so high. Unemployment's high. The cost of investment is high, so I'd really say it's time to lower those rates.
Okay, you're at 50-50. Ted, what about you? When you look at the decision for tomorrow, what do you think will happen? Will it be a rate cut?
Well, the Canadian economy is ready for a rate cut. Whether it happens in June or July doesn't really matter that much. I think what is driving the decision is really the bank being concerned about where inflation is in the United States, and that we certainly don't want to get into a situation where Canada is diverging from conditions in the U.S. So our bet is, and we've been saying since September, that mid-2024 is when the rate cut is going to happen, and I think we caught that one correctly. So whether it's tomorrow or sometime in July, it's immaterial for the economy.
Okay, Ted, build on that a little bit, if you will. Dig into this debate that could be happening right now behind the bank's doors. You reference inflation in the United States. Talk to us a bit more, with more detail, if you will, about some of the reasons the bank might actually use to forego an interest rate cut for tomorrow.
Well, I mean, because conditions can change a lot. Over the past year, since we made the call that mid 2024 would be the time that rates come down, we made that call in September last year. Well, soon afterwards, people were concerned that rates would still have to go up, and there was really high inflation really happening then. Well, then inflation in the U.S. cooled off tremendously in the late part of 2023, and then the expectation was that rates would start coming down in April, and maybe quite quickly. Well, turns out that inflation kind of reignited in the U.S. Somewhat, not so much in Canada, and the expectation is that these things will shift around. So, the markets and the inflation numbers are kind of fickle. They do move around. We're looking for consistency in how prices move. So even 3 months to 3 months is not enough to get a sense of have we solved this inflation problem. And our view is that the bank would want to be reasonably comfortable that the U.S. rates would start coming down, not immediately. We don't think that U.S. rates are going to come down in June and July. But if they're pretty confident that U.S. rates would be able to come down in the early fall or late fall, then I think the bank is able to make that movement now.
Mm-hmm. Kaylie, do you want to add to the conversation here? Because as we are hearing from Ted, of course, the two economies, Canada and the United States, very tied very closely together. We were always looking for conditions south of the border. What do you make of that argument?
Well, I think that if we look at where inflation has been this past year, we've seen that in Canada, we're firmly in that 1 to 3% band. Again, like I said, we have been all year. And if we're thinking about what the bank is talking about, I hope that they're talking about our own economy and looking at the strength or weakness of different measures. So we look at economic growth, and the economic growth we saw in the first quarter, it's just about 0.4%, which is not very strong, and continuing to have these high rates keeps that throttle on our economy at a time when we know unemployment is high, people are looking for jobs, people are looking for better jobs. There's lots of businesses who would like to be starting to invest. There's also this, housing crisis that we have, and we need to be investing in housing, building housing. Those high interest rates are really putting a throttle on that as well. I hope that the bank is talking about that as they're making this decision so that we can move forward on our other goals.
Okay, and so the implication is that there would be a negative economic impact then on the Canadian economy if the rates are not lower tomorrow. Is that what you're saying here, Kaylie?
I think that the longer the rates are held high, the longer then we have to wait to get going on these other things that we need to be doing, like building more housing. We can think about the interest rate is one policy tool, but there are other public policy tools that need to be used in order to get going on building the economy that we need in the future and not just stuck in this problem that is clearly handled.
Ted, what do you say to that? Because, I do have this question about whether or not there is a danger in foregoing a cut in June. What kind of impact would that actually have on Canadians and the economy here?
Well, I think the Canadian economy is ready for a rate cut. So we feel that June would take probably the highest likelihood. And that's what our official forecast is, although we're going to be finishing our forecast after tomorrow. So if it's not June, it's most likely going to be July. I think it would be kind of damaging. It would be damaging for the Canadian economy to continue at rates this high. We're probably about 2.25% above what the neutral rate is, and that's considered the rate of interest that doesn't have a stimulative effect nor a contractionary effect on the economy. So even a quarter point cut still means that rates are in the contractionary or the limiting territory, and so I think there is enough movement in at least slow movement in the economy to justify moving to a lower rate in Canada, and even stepping ahead of the U.S. But I still think that the Tiff Macklem and the Bank of Canada needs some sort of assurance that the U.S. is going to be moving relatively soon within the next few months.
Kaylie, if the bank decides tomorrow not to actually drop interest rates in any way, shape, or form, what would you want to hear from Tiff Macklem, the Governor of the Bank of Canada? What do you actually want to hear in terms of a message from him if a rate cut is not his decision?
The Bank of Canada has actually already signaled that they are going to reduce rates. We just don't know when. What I want to see is this rate cut tomorrow, and that we don't wait. Ted is saying as well that the economy is ready for this rate cut. Folks who are renewing their mortgages in the next little while would like to avoid the pain of that additional 0.25%. Some people might think that that's not a lot, but for many of us, it is an incredible amount. And the more we can see that rate coming down, the more people can start to plan with the certainty that it will continue.
Yeah, and I appreciate that. But if at the end of the day it's not a cut, but just a signal, another signal once again, the cuts are coming, what do you want to hear in terms of a justification from Tiff Macklem?
Honestly, I don't think that there is one. We're in a position where we're ready for a rate cut, and we just need to see it happen.
Ted, would it be enough to just signal that cuts are coming if one isn't imminent for tomorrow?
Well, I'm with Kaylie on this one. I think all the evidence is there for the cut. If it's not there tomorrow, then he pretty well have to signal that it has to be July. There's no really good reason to keep it on until September.
Now, if rates are cut, and you mentioned a figure there, Ted, it seems that the cuts eventually, now and in future, would be gradual. How much relief does that actually create for Canadians? What type of stimulus does that create for the economy? Ted, I'll ask you to start that one.
Well, I think what it means is that there's an assurance that we've turned the corner in this, and generally in the business sector, most business loans lending is done on a variable rate basis, so they pay based on what the current rates are. So if rates start to come down, it's a signal that people can start making those kind of investment decisions that ultimately mean for better production and better productivity and better outcomes down the road. The housing side is a little more complicated generally because the bank shouldn't be setting housing policy. That's the reason we're into a big mess in housing right now with high costs and high rates are largely because of bad policy at the metro, at the provincial and the federal level. So most of the repairs to that have to take place on the government side. The bank can only deal with these large elements of short-term interest rates as best they can, knowing that housing is connected to it, but it doesn't drive the whole economy.
And Kaylie, that is an interesting point that, how much relief would really be provided to Canadians if what we're talking about is a gradual cut tomorrow rather than getting back to a neutral rate as Ted was talking about?
I think that the relief will be palpable only because it's signaling that we've turned the corner. So in that way, I totally agree with Ted. There are completely different things that we need to do in order to deal with the housing crisis that's going on. But the relief will be palpable in terms of businesses starting to invest to create more jobs and folks planning for mortgages knowing that the interest rate is going to start to go down.
Okay. Well, of course, we're watching for tomorrow. And ahead of that, thank you both, Kaylie and Ted, for the time this evening. Appreciate it.
Thank you.
My pleasure. Thank you.